when I ever see that slide come up earlier when it's like Natalie Harrison from Cape Town, it's not as exciting as where these guys have all come from. So thank you for making the trip to South Africa. You've already heard from David from Lyrical and Mark from Jenison. So we've got a panelist, Cristina Dyer. She's one of the portfolio managers on our Curate Global Quality Equity Fund, representing, obviously, even though you heard from Hugh earlier. So there's some questions that are coming through on Slido, so please do continue to send those through. But I'm going to start by not talking really about the philosophy and processes, really. I think you guys did that really well. I think I'm going to really focus firstly on AI, because what global presentation doesn't have a lot of focus on AI these days, or news headlines, or social media, TikTok, Snapchat. So Mark, obviously being the growth manager amongst the three here on the stage, I'm going to first chat to you about AI. You showed a slide on the capex of the hyperscalers, and obviously the significant amount of money that they're spending. You quoted, I think, $650 billion, which is crazy amounts of money when you think about it, on those four businesses, those top four. Now, the question that I often get, and it's coming a lot in the news, is there a risk that these companies are overspending? I know you said that there's demand through those token growths, but when will revenue actually come through, and at what pace to justify the amount of capex they're spending now and in the foreseeable future? So that's the one question. And I suppose linked to that, any other risks that you're potentially seeing in this AI trade?
Sure. Yeah, no, this is obviously a big debate in the market. It has been for over a year, and I don't think it's going to go away anytime soon, to be honest. So, as I said in the presentation, the one thing we're focused on very closely is demand growth, because if the demand is there, and the computing capacity is sold out and they're building more, that's what they should be doing. And we have to trust that the management of these big companies aren't crazy, because they've been too conservative, if anything. They haven't spent fast enough. Amazon's lost a lot of market share. Microsoft is in the process of losing a lot of market share because they're not spending fast enough. So the cloud computing game is a little easier to see, and because you know the revenue growth of those companies. Now, for the real AI companies, so that's where the new revenue source has to come from, the monetization. We are starting to see it finally. Anthropic is now at a $14 billion revenue run rate after just 3 years. That's up tenfold from last year, and that was up tenfold from the year before. So Anthropic's revenue is growing tenfold every 12 months. And $14 billion for a software company, by the way, is huge. Very few have ever passed 10 billion organically. And so this will be one of the fastest growing quote unquote software companies in the history of mankind when it goes public. And it'll probably go public at 750 billion market cap or $1 trillion. So it's big. OpenAI has about 20 billion of revenue, only subscription based, and a very small percentage of users, probably including most of you in this room. Well, a very small percentage of users pay a subscription for the premium version. Most people are on for free. And they will start monetizing in 3 areas: advertising and commerce, so e-commerce, and then on agentic tools like Claude from Anthropic. So they're targeting, these are OpenAI's goals. We don't know if they'll achieve them. They're targeting 100 billion of revenue in 3 years. So that's where you're going to start to see the proof. And again, as we meet with private companies, they're getting blue chip customers to sign up for things like customer service, where you're using a chat bot to complete 100% of the customer service interaction with you and me, instead of one of these horrible experiences we go through if you call your telecom company or your cable company, or you call a company that you bought something from and you want to know where it is. This actually handles all of that with linkage to every system involved, including right down to DHL delivery. And so the agents move around all these databases collecting the relevant information and come back and give it to you. And so the customer satisfaction is very high with these new breeds of services. So we're pretty excited about that. So we just need to be patient. So the monetization's already there for cloud computing. The monetization is starting small, but it's already multi-billions from the new software companies, I'll call them. And this is, when the internet was created, nobody knew how to use it, et cetera, et cetera. It was like, you're going to buy a book online. I don't know. And what did we get out of that a decade later? We got the most valuable companies on earth. Amazon, Google, Facebook, Apple with the introduction of the mobile internet, the iPhone. And this cycle is going to be no different. In 5 years from now, hopefully I'm still here, or I will have been really wrong. There's going to be a whole new set of market cap leaders that you're going to be talking about over wine, and they're brand new. It's going to be the next Google, the next Microsoft, the next Apple, etc. So it's going to be very, very exciting.
I suppose, and also, as you said, I mean, if your expectations on some of these businesses are wrong, or the risks are higher than you expect, and that's where you guys come in and you sell and you find a better opportunity in those particular industries. Maybe on that point of risks, I've actually got a slide here that's, someone's actually asked a question also, so it's quite opportune that I've picked this myself. But this is a slide, thank you, Nick, from Jennison, for actually sharing it with me. But it basically highlights the carnage that we've seen in software stocks more recently. And that's really been due to the more recent, I suppose, Anthropic Claude Cowork announcement and some of its plugins, and what the expectations of that, I suppose, launch is going to have on some of the software stocks' business models and their potential earnings. So I'm going to ask you, Cristina, from a quality perspective, because you, from a quality manager, do you have quite a few stocks that have been hard hit by this particular move? I do think, and you're starting to see, it's been indiscriminate selling. It often is that case with the markets. There's one negative move and everything sells across the board. And I don't think it's a fair representation of the quality of the businesses that you've selected. So if you could just highlight how you're thinking of what's going on in this market and maybe why you think there's great opportunity in the stocks that you have.
So it's a great chart to look at. And if you look at this, you see this, you think some sort of big event has happened. This company has missed on earnings. They cut guidance. But what we've seen is that nothing like that has happened with the stocks. All of the move is been PE compression. So they've been meeting targets. They've doing the same top line growth they've been doing for a long time, the same profit growth, the same earning growth. The disruption is purely to do with the narrative currently in the market, which is AI, and that cloud co-work is going to disrupt these companies. So the exposure we have in the even load portfolio is towards companies that sell data. They're data vendors, so they're technically classified as industrials, but they're trading very similar to the software stocks. So what these companies do, they're names like Relics, Wolters Kluwer, Experian, London Stock Exchange. So they sell all sorts of data and analytics to professionals to help them make decisions. So accountants, lawyers, financial institutions. And they have a lot of generations of data and also how this information is being used. And on the way here, Hugh has been reading a lot of books about South Africa and a lot about South African history. So he's a very kind and generous man. He's been sharing a lot of this information with me on the way here. And you know what, the population of South Africa is roughly 60 million. Like the size of South Africa is 5 times larger than the UK. And this is all great, but us being here doesn't replace the generational knowledge that the people that live here have, the local intelligence that exists on the ground. And what the corporates speak is, for this term, is proprietary ontology. So all of these companies, Relex, Experian, Wolters Kluwer, they don't just sell you the pure commoditized data that you can find on Google. They sell you the really valuable stuff, how this information is being used and implemented in practice in real life. And for you as a business and enterprise, it's very risky to pull out all of this history of use and data to start using instead some sort of application that was vibe coded in an afternoon in someone's garage. You're never going to do that, right? From a compliance, a risk perspective, you have to show your workings to the regulator as well. So we think, to use David's expression, that our portfolio is very sexy as well at the moment because we have these amazing companies that the fundamentals haven't changed, but they're trading at a massive discount in the market.
Awesome. Thank you, Cristina. I suppose maybe the next question then I'm going to land to David. Obviously, we've seen this. It's quite a nice segue because the market's sold off.
I thought you were going to say sexy and then.
Oh, well, and that. But the market's sold off. There's a lot of attractively priced, I suppose, stocks on the market. But from a value manager, you navigate the cheapest part of the market, right? The cheapest quintile. How do you ensure when you're buying stocks, you're not buying the ones that are cheap for a reason? You're not going into those value traps. What is the way that you think about avoiding those stocks that are cheap for a reason?
So value traps is just a fancy word for mistakes. And we make plenty of mistakes, but we happen to also have a lot of winners. So the winners make up for the mistakes. We actually measure our hit ratio in terms of how right we are in earnings and the stock, etc. We have about a 60% hit ratio, which is rather high in the market. But the way to avoid mistakes is obviously to control what goes into the portfolio. And then when it's in the portfolio, make sure you don't have too many eggs in one basket. And then make sure that it exits the portfolio when it needs to. So there are 3 parts to that answer. So in terms of what goes into the portfolio, we have a very defined process: value, quality, and analyzability, right? Cheap, good, and simple. And we just stick to that process. And that makes sure that we don't get as many value traps in the portfolio, because we look not just for value stocks, but for the good businesses among the value stocks that are analyzable. So we stay away from the bad and unanalyzable businesses, even though they also may be cheap and some of them may work out. Now, in terms of in the portfolio, what we do is we try to avoid too much concentration, because we already have a very concentrated portfolio of 50 stocks in our global value fund. So we look to have no more than 5 stocks in any one industry. And in fact, among our 50 stocks in the global value fund, we have about 46 different industries, because they already have the value factor. So we want to make sure that you don't have too much exposure to anything else. And in terms of the stocks exiting portfolio, we have 4 very strict reasons for selling. Number 1 is, if a stock reaches fair value, we take it out of the portfolio. We don't hold it if it's already reached fair value. Number 2, if there's a merger and acquisition in the business, we just sell. We don't stay in. And if there is sometimes a superior substitution outside of the portfolio, something that's even cheaper and a better quality, then that will push out something in the portfolio. And then finally, we lose conviction in some stocks, mistakes, or recognize mistakes, and we just take them out. But there are sometimes small things that happen that are not as obvious, something like reaching fair value. That's kind of an obvious thing, something we can measure. Sometimes there are smaller mistakes along the way. So we've instituted a process that we call the yellow card rule. And there may be things that happen with stocks along the way that are not clear enough to sell them as a mistake, but it's something that makes us think. We sort of say, that's sort of weird. They miss earnings more than 10% in a quarter, for example. So we give it a yellow card. And if something else happens like that along the way, they get another yellow card. And on the 3rd yellow card, they're out, no matter what. And now they can retract the yellow cards if they improve, from having lost earnings. But that's sort of the way that we sort of consult them out of the portfolio. And that way we manage to stay away from a lot of mistakes or value traps.
Well, thank you. Thank you, David. I suppose then talking, because a lot of you spoke a lot about the sell, I suppose how you stay away from stocks and your sell discipline also. Naturally, that goes to you, Mark. A big reason why there's a lot of growth managers that are well known in South Africa and well widely used, actually. But when we look globally to find these best of breed managers, besides them being very distinct in terms of the investment processes and philosophies, something that stood out from us from a growth perspective was Jennison's sell discipline, which is so important, especially in a market where there are potentially higher valued stocks, what people perceive potentially higher valued. So perhaps if you can just answer 2 questions. We've had the 2 team members here, Lyrical and Even Ode, so it's generationally cheap and free cash flow yields of 5% above the markets of 3%. So clearly there's value there. Where's AI, where's growth manager sitting now from a valuation perspective? And then also, if things change in your mind, what is your sell discipline? Or what do you look at when your thesis of any of these companies have changed?
Sure. Yeah, in terms of, we don't quite understand why. I mean, we can make up reasons why, but that's not helpful. Intellectually, we don't understand why our portfolio is so cheap. The big leaders in the market are selling at, in many cases, discounts to the S&P 500, which is crazy because they're putting up monster growth rates. And the consensus estimates also show for continued very, very strong growth. And our estimates are higher than the consensus. And we could be wrong, but the market's not pricing in any kind of optimism. Let's put it that way. So it's a very curious market, and it may be just more risk averse. I think there's an unsettled nature, obviously, to the global economic system, thanks to the United States. And I think there's also an unsettled, long duration understanding of what Gen AI is going to do to different industries that may be weighing on confidence. But whatever it is, it's pretty inexpensive. So we actually don't worry about valuation at all, given the environment today. We're just focused on fundamentals. On the sell discipline, it's really important. Every company has its day, right? So some may last a decade or longer. Some may last 3 years. I mean, if it's a healthcare company, it's going to last 3 years on average. You get in early, they launch a multi-billion-dollar blockbuster drug globally. If it's a very good drug, it'll get utilized very quickly. The PE multiple of that company will expand fairly dramatically, not just on the earnings growth, but on the outlook. And then you're going to start to see competition come into the market with early stage development efforts to go after that big profits pool. And then the multiples always start to do this over time. And so you have to sell, so those are product cycle driven stories, which we have in our portfolio. They're different than those long duration big compounders or long duration stable growth. But even in the case of long duration stable growth, that kind of low double digit growth, a good example is Ferrari. We owned it for 8 years. It was one of the best stocks to own in the European market, and in the global market easily beat MSCI. And it's not dynamic. It is sexy, but it's not dynamic. I mean, you can't visit that company and not want to. You just can't bring a checkbook with you because you'll be broke when you leave. The product is phenomenal. So very steady growth algorithm, mid-single digit volume growth, 3 to 4% pricing growth through mix, special edition vehicles, whatever, and then 3 to 4% pricing from revenue growth from customization. You want the yellow Ferrari horses on the side of the vehicle, $3,000. All right. And so the average customer spends $80,000 on customization. So, and that's all huge profit, right? So that growth algorithm worked for a long time. And so the stock got a very premium multiple as a result of it. It was a 6-bagger for us in terms of the earlier conversation. And then in October, it was over. They had a big investor day. They cut the growth rate in half, said volume growth is now going to be 0 for the next 5 years because something's going wrong in their algorithm, and they want to cut back supply to make it more scarce. So we don't try to ask too many questions about that. All we know is the management thinks it's not the same Ferrari. And so we sold, 90% of our holding that day. So the sell discipline's key because you want to lock in all of that alpha that you earned over a long period of time. You don't want to give it back thinking that, well, it'll get better someday in the future. It's a great brand, et cetera. No, it's broken until proven otherwise, and we don't need to be there. So when we see a change in the fundamental strength of the company, their ability to exceed consensus expectations is now waning, and it's usually highly valued by then. You have to sell. Tesla is another good example in October of 2022. That's the first time they ever missed shipment numbers. You have to unload. Because it's going to turn out to be pretty messy.
Awesome, thank you. And I suppose then just quickly, we've got a lot of questions, and so I'm so glad the team, everyone here is going to be around to answer some questions. So I can't get through them all. I'm going to quickly touch base on portfolio overlap because I think it's a really interesting slide. Well, personally, I said earlier, we chose these managers for their very distinct reason. And what's interesting, although they concentrated portfolios, you heard Sanisha earlier talking about it's time for stock pickers. It's the market for stock pickers. This is what these team members are doing for each of their portfolios that they manage for us. Of their portfolios, and we can always send you, your fund specialist can send you the full list or breakdowns of exact stocks they hold. But what's interesting between the quality and growth manager being Jennison and Eveno, there's only 4 stocks that are overlapping. But something that's more interesting to me is the fact that all 3 of these managers that follow a valuation principle, that look at fundamentals, businesses with strong business moats, durable businesses, sustainable business models, structural growth, but then obviously a company like Jennison that looks for structural growth tailwinds, all of them find a business case or an investment case for Nintendo. So I would love you, all 3 of you, to just touch base on your investment thesis coming from probably very different reasons and angles.
Sure, happy to start. So for us, any company we look at, for it to fit our definition of quality, it needs to have strong financial metrics, and Nintendo more than fits the box there. But also they need to know what their competitive advantage is, and they need to demonstrate to us that they're investing to protect that competitive advantage. And for Nintendo, that is the IP and the hardware design they've been built over generations. A big structural advantage the company has is that now we have something like 4 or 5 generations of people that have grown up with this IP and love this IP. So I know Ray just bought his daughter's a Wii console. So we've had Nintendo for a long time, is going through a console cycle right now. It's been a bit sold off by the market, but we don't think the fundamentals have changed. The games are very fun to play. They understand what their market is, which is family-friendly video games. I say sometimes that Princess Peach and Mario are never going to run a drug cartel in Vice City. They don't compete for that market. And I think it's a good stock to have for the long term.
Lyrical?
Sure. We have value, quality, and analyzability. So let's look at it from those perspectives. Value, is it cheap? So Nintendo is trading as 13 times next 12 months earnings. It's cheap. The market's at 20. MSCI US is at 22. Definitely a cheap company. Is it a quality business? Well, absolutely. 20 out of the 25 biggest games in history have been Nintendo games. Mario and Pokemon have made more money than Harry Potter. Clearly a good quality business. Has an ROIC, return on invested capital, of north of 40%. So well above our hurdle of 10%. And if it's analyzable, absolutely. No, they're just launched Switch 2, and launching these launching a new Switch is sort of like launching a new iPhone, and very analyzable business. So it fulfills and checks all our boxes of cheap, good, and simple. And that's why it's in our global value portfolio.
If I build on what Cristina said about the competitive advantages and its position, place in the marketplace, that we would, obviously completely agree with that. And then the second aspect that attracted us to it is we are looking for product cycle stories, right? These are non-correlated, idiosyncratic ideas in the global marketplace. Doesn't have anything to do with AI or anything else. It's just has a very unique product cycle coming with Switch 2, which was launched last July to great fanfare. And unfortunately for Nintendo, it is, given all three of us on it, it is your worst contributor to return in the last 8 months. So it's on the short leash. So what they have to do at this point for us to continue to own it is they have to launch very successful games that are you can only play on the Switch 2 platform. And they haven't really successfully done that yet. But they have a big product launch schedule coming up over the next few months. And if it really is well accepted by the market, it's, green light, and it's really going to move because it is inexpensive. But the market's very concerned that it's going to be disappointing at this point.
Yeah. Watch the space for Nintendo video games releases.
Maybe following up on portfolio positioning from a global perspective in terms of how you put together or construct your portfolios. I mean, this is just there's 5 stops there. But Lyrical and Evenload primarily focus on developed markets. Jennison, from our growth manager, also takes a stab in emerging markets when there's valuations. I mean, you've got Mercado Libre as an example in terms of a stock. Perhaps you can explain how you're taking advantage of your global mandates from different perspectives. So what's your positioning against the US? Because that's often a question we get, and it's actually a question that's come up. And then I suppose, Mark, you can also just delve a little bit into your emerging market thesis.
Sure. On emerging markets, we don't view it as an asset class or a unique set of companies. It's just sitting there, right? We invest bottoms up. So for us to be involved in emerging markets, it's because we find a really interesting company doing something very unique. And if I look at the last 15 years, I think our peak in EM weight was probably 25%. And that also matched the boom in China internet and internet around the world in emerging markets. And our trough has been as low as 3%. And today it's at a reasonable level. I mean, it's sub 10% right now. But as a growth manager, we're not looking to replicate beta in emerging markets because we don't think that works anymore. It hasn't worked for a long time. We don't look to replicate growth rates because the United States grows faster than Brazil. So why do we care about the growth rate of the country? We're just there if it has a great idea. So if you look at Brazil, for example, we own Nubank, which is a digital bank. 46, well, no, now it's over half. It's 56% of the adult population of Brazil has an account with them. And there's no branches. It's all on your mobile phone. And it provides a complete range of financial services at very low fee. And they use AI to figure out credit scoring for customers because credit scoring doesn't exist in Brazil. So why Nubank is successful and has been a good stock is they are meeting unmet need in the marketplace. It's as simple as that. They're solving for convenience and low price. And that company's growing like a weed. So that's the kind of emerging market stock we're looking for. Not because we don't play in commodities and traditional financials and things like that, old telecom. We're really looking for excitement. And unfortunately for China, the government ruined the internet. And that was the hotbed of innovation in that country. Great growth companies there that we owned for years, like Tencent, Alibaba, et cetera. But we're not active there today.
So for us, we look for companies with strong fundamentals. We find that most of those companies are in developed markets. So what we say is that we wouldn't own the second best company. So Hermes is an example of a company that we have in the portfolio because we think it's the highest quality you can get in the luxury sector. We wouldn't own a Richemont. So we would rather have a concentrated portfolio of companies with strong fundamentals. We have exposure to emerging markets because a lot of the companies we own, they generate over half of their revenue from emerging markets. So a lot of consumer staples generate a large part of their revenue in emerging markets. Experian participates in the Brazilian credit market as well. So that's how we position the portfolio for now.
And yourself?
We're pure bottom-up investors. So the asset allocation in terms of the global fund, we are underweight the US, but it's a result of just finding better opportunities elsewhere. But it's pure bottom-up. So we don't make any reallocations to countries or regions based on what we believe that region may do. And again, just to emphasize what Cristina mentioned, is that many companies obviously have their earnings come from various reasons, even though they may be listed in a certain country. We own a company called Elis, a French laundry company. They take laundry from hospitals, uniforms, etc., and they wash it in central place instead of having the hospitals wash their own laundry, for example. It's a French listed company, but you can find Elis in the UK as well. You'll see their trucks driving around picking up laundry as well. So its earnings, even though it's a French listed company, may come from various places, wherever they've decided to do business.
So thank you, David. Very different positioning, but I think what's important to hopefully you got from today is that all three of these managers are focused on their philosophy. They don't deviate. And I think that's an importance. Each portfolio and I suppose investment style is going to go through periods of outperformance and underperformance. And that's a big reason why we actually advocate blending the investment styles, because you can never time when to enter and when to exit. So, and definitely, if anything, all of these portfolios have value to be had. They've all said they have value. I've never heard of that before in my life, but so they've got value, different positioning. They think differently. Whilst they've got emerging market exposure directly or indirectly, it's globally diversified. And from a access point to these particular strategies, we've got US dollar denominated portfolios, but we're in the process of launching rand denominated feeder funds because of the demand for these portfolios. Thank you so much.